4 nations. Just 4. Control what remains of the Earth's most valuable buried wealth. Not the metal already mined, not what sits in vaults or central banks, but what is still underground, waiting. And whoever holds that ground may quietly hold the future of gold, of silver, of platinum. Most investors are watching the wrong numbers. They are watching prices. They should be watching maps. Because in one country, a single nation controls 83% of a metal the modern world cannot function without. Not 60%, not 70, 83, and almost no one is paying attention. By the end of this briefing, the picture will be impossible to ignore. Welcome to Precious Metals Intelligence. This channel exists for one purpose: to examine the structural forces shaping the future of monetary and industrial metals calmly, precisely, and without the noise that dominates most financial media. Most people believe they understand gold, silver, and platinum. They think of coins in a vault. They think of bars stacked in a bank. They think of the price shown on a screen rising and falling each day. This is the world most investors watch. But it is only half the story, and it may be the less important half. There is another kind of wealth that almost no one talks about. It sits far below the surface of the earth, untouched, unmined, and largely unmeasured by the average person. This is the reserve wealth, the metal that has not yet been dug out of the ground. And unlike the gold sitting in a central bank vault, this hidden wealth cannot be moved, hidden, or quickly brought to market. It belongs to whichever nation happens to sit on top of it. This distinction matters more than most people realize. Above-ground metal is already in circulation. It is owned, traded, and stored. It reacts quickly to demand. But underground reserves are different. They represent the future. They represent what will still be available in 10 years, 20 years, or 50 years, once today's mines slow down or run dry. A nation with large underground reserves holds something that cannot be printed, borrowed, or manufactured. It holds geological luck, and geological luck does not shift with elections or interest rate decisions. This is why serious analysts do not stop at the price of gold when they want to understand the future of these metals. They ask a deeper question. Where is the metal that has not yet been mined? Who controls it? And what happens when the easy-to-reach reserves are gone? The answer to that question is more concentrated than most people expect. It is not spread evenly across dozens of nations. It is not shared fairly around the world. Instead, it rests heavily in the hands of just a small number of countries. 4 nations in particular hold an outsized share of what remains. Their names will already be familiar to anyone who follows global trade or resource markets, but their level of control may still come as a surprise. This concentration creates a kind of quiet power. It is not the loud power of armies or elections. It is the slow, structural power of geology. A country that holds a large share of the world's remaining silver or platinum does not need to raise its voice to matter. The world simply needs what is inside its ground. Over time, as easier deposits elsewhere are exhausted, this power tends to grow rather than shrink. For business professionals and long-term investors, this idea should feel familiar. Markets often reward those who look. When people picture the world's gold supply, they often picture central banks. They picture large buildings filled with stacked bars, guarded and counted. But this picture only shows gold that has already been pulled from the earth. It says nothing about what remains buried, waiting for the next generation of mining. And when analysts study that buried gold, a surprising pattern appears. The distribution is not balanced. It leans heavily toward just 2 nations. Australia sits at the top of this list. Beneath its soil rests an estimated 13,000 metric tons of gold, still unmined. This is not a small figure. It represents close to 1/5 of everything believed to remain on the planet. In other words, nearly 1 out of every 5 ounces of gold left to be discovered and extracted sits somewhere under Australian land. Few people outside the mining industry appreciate the scale of this number, yet it quietly places Australia in a position of long-term influence over the future gold market. Russia follows closely behind, with reserves estimated near 12,000 metric tons. The gap between the 2 nations is small enough that either could reasonably be called the true leader, depending on new discoveries or revised estimates. Together, Australia and Russia are believed to hold nearly 2/5 of all known gold reserves left in the ground. That means 2 countries alone may control close to 40% of the world's future gold supply. This is not a minor statistic. It is a structural fact that shapes how the gold market will likely behave for decades. South Africa tells a different kind of story. For much of the 20th century, it was the world's leading gold producer, famous for deep mines and a long mining tradition. Yet, when it comes to what remains underground today, its position has fallen. Estimates place its remaining reserves at around 5,000 metric tons, a fraction of what Australia and Russia hold. This shows an important truth about resource wealth. A country's mining history and its future potential are not always the same thing. A nation can lead the world in production for a century and still hold far less for the future than a newer player. Indonesia and Canada round out the next tier of nations. Indonesia holds an estimated 3,600 metric tons, while Canada holds close to 3,200. These are meaningful figures, but they are far smaller than the totals held by the two leaders. When placed on a single chart, the gap becomes clear. Two nations tower above the rest, while several others share what remains in smaller portions. Globally, experts estimate that around 66,000 metric tons of gold remain to be mined across the entire planet. Of that total, roughly 1/5 sits in Australia alone. This single fact reframes how the future of gold should be understood. It is not simply a question of demand or interest rates or central bank buying. It is also a question of geography, and geography rarely changes. There is another layer to this story that deserves attention. As central banks continue to buy and hold gold at record levels, and as many existing mines report declining ore quality, the importance of new, high-potential reserves grows sharper. Miners increasingly must dig deeper and process more material to extract the same amount of gold they once found easily near the surface. This trend makes the remaining large reserves, especially those in Australia and Russia, more strategically valuable with each passing year. For long-term investors and business professionals, this pattern offers a lesson beyond gold itself. Concentration of a scarce resource in the hands of a few nations tends to shift power slowly but steadily over time. It rewards patience over panic, and it rewards those who study structure rather than headlines. Gold has always been viewed as a symbol of stability, but the story of where it still remains, buried and unclaimed, shows that even stability has a geography, and that geography is far less evenly shared than most people assume. This pattern in gold is only the beginning. When the same lens is turned towards silver, a different but equally revealing picture starts to form. Silver tells a different story than gold, though the underlying lesson is just as important. While gold's future supply rests heavily on the shoulders of two nations, silver spreads its remaining wealth across a wider group of countries. At first glance, this might suggest a more balanced, less risky picture. But a closer look reveals that even this broader distribution still carries a familiar warning about concentration and control. Peru stands alone at the top of the list. Beneath its land rests an estimated 110,000 metric tons of silver, still unmined. This figure represents close to 18% of the entire world's known silver reserves. To put that in perspective, nearly 1 out of every 5 ounces of silver left on the planet sits somewhere under Peruvian soil. This places Peru in a position of quiet but significant influence, similar to the role Australia plays in the gold market. Few casual investors think of Peru when they think of silver, yet its geological position gives it outsized importance in any long-term supply conversation. Russia and Australia follow with reserves that are remarkably close to one another. Russia holds an estimated 92,000 metric tons, while Australia holds close to 91,000. This near tie is worth noting. It means two of the same nations that dominate the gold conversation also appear near the top of the silver conversation. This is not a coincidence. Certain geological regions are rich in multiple metals at once, which means a handful of countries end up holding disproportionate influence across several markets simultaneously, not just one. China ranks next, with reserves estimated at 67,000 metric tons. This adds another layer to the story, since China is also one of the world's largest consumers of silver for industrial and manufacturing purposes. A nation that both produces and consumes at this scale holds a unique kind of leverage, one that differs from countries that simply export raw material to others. Poland completes the top 5, with reserves near 59,000 metric tons. This number becomes especially interesting in light of a significant silver discovery reported in the country in recent years. That discovery meaningfully increased Poland's known reserves and reminded analysts that reserve estimates are not fixed numbers carved in stone. They shift as exploration continues, and a single major discovery can reshape a nation's position on the global list almost overnight. Even with this wider spread of nations, the concentration story does not disappear. When these top 5 countries are combined, they are... If gold shows moderate concentration and silver shows broader distribution, platinum reveals something far more extreme. This is where the story shifts from interesting to genuinely alarming for anyone who studies global supply risk. Platinum is not shared among several nations in any meaningful way. It is controlled almost entirely by one. South Africa holds an estimated 63 million kilograms of platinum group metals still in the ground. This figure represents approximately 83% of the entire world's known reserves. That number deserves to be repeated slowly, because it is easy to read past without absorbing its weight. 83%, not a plurality, not a leading share, a near-total monopoly over a metal the modern industrial world cannot function without. To understand why this matters, it helps to think about what platinum group metals actually do. They are essential in catalytic converters, which reduce harmful emissions in vehicles across the globe. They play a growing role in hydrogen fuel cell technology, an area many governments are betting on for the future of clean energy. They appear in electronics, medical devices, and specialized industrial equipment. This is not a niche metal used only by collectors or jewelers. It is a working metal, woven into the infrastructure of modern manufacturing. Russia holds the second largest share, with reserves estimated near 11 million kilograms. While this is a meaningful figure on its own, it is dwarfed by South Africa's position. The gap between first and second place here is far wider than anything seen in the gold or silver reserve rankings. There is no close competitor. There is no near tie. There is simply South Africa, and then a significant drop to everyone else. Zimbabwe follows in a distant third position, with reserves near 1.3 million kilograms. The United States holds close to 590,000 kilograms, and Canada trails further behind with roughly 310,000 kilograms. When placed on a chart, these remaining nations appear almost flat compared to South Africa's towering share. This is not a distribution. It is a single point of dominance surrounded by minor players. This level of concentration creates a structural vulnerability that deserves serious attention from anyone who studies global supply chains. When 83% of a critical resource sits within the borders of one nation, any disruption in that nation carries outsized consequences for the rest of the world. A labor strike, a policy change, a period of political instability, or an infrastructure failure can ripple far beyond South Africa's own economy. This helps explain why platinum has historically shown sharper price volatility than gold or silver. Its supply is simply more fragile because it depends so heavily on the stability of one place. This fragility also affects how platinum is viewed by long-term holders of wealth. Gold and silver are widely recognized as monetary metals, used for centuries as stores of value with deep liquidity across global markets. Platinum has never fully earned that same trust. Its usefulness in industry is undeniable, but its dependence on a single, sometimes unstable source makes it a riskier foundation for those seeking stability. It occupies an unusual position, essential to modern technology, yet less dependable as a long-term store of wealth. Taken together, gold, silver, and platinum tell three different versions of the same underlying story. Some resources are shared moderately, others are shared more widely. But platinum stands as a clear warning about what happens when a critical resource becomes tied almost entirely to the fate of one nation. As the world becomes more dependent on clean energy technology and emissions control, this concentration is unlikely to matter less in the years ahead. If anything, it may matter a great deal more.